Hi Robuxo traders, welcome to our new market update. Well, trading is tough, right? Yeah, well, sometimes trading is really about patience. I will tell you a quick story about my trading in 2022 to 2024 on stocks, because you probably know that stocks were in a drawdown since the start of 2020 until the second half of 24, at least most of them. I was with my algorithmic portfolio in a drawdown the whole year 2022, and at the start of 2023 a few big stocks really started picking up. But do you know what my portfolio was making? Well, it was making new lows. Why? Because the market, the whole market, was still very weak. And that's something we can see even on crypto these past few months. We can see how Bitcoin is performing, how Bitcoin is close to new all-time high. But on the other side, the broad crypto market, the crypto market that we are trading, is going sideways, is in quite a deep drawdown, and really it's not in very good conditions. But it happens from time to time. There are only few coins that are trending a lot, and another time the whole market is trending a lot. Well, sometimes I get a question about, should we trade Bitcoin only, for example? From my point of view, this would suffer from huge bias, because yes, right now Bitcoin is trending the most, but on the other side, over the long term, we are in crypto because of the smaller projects. We are in crypto for big gains, and big gains are made with high beta. It means by projects that are really very volatile. Let's look at this market update. Let's look at how we should think about trading with the long-term perspective, and how not to think on the other side about trading in general. So firstly, small test. Would you trade this strategy? This is trend catcher long. You can see that it is in a drawdown over 7 months. It was making pretty nice profits, but right now it is really going to the south and it is losing a lot. Plus, it is making pretty deep drawdown. Right now it is in a drawdown of up to 50%. And that's not all. The drawdown is also one of the longest ones. You can see that such a drawdown is more than 200 days. Well, would you trade this strategy? I would. Well, we are even trading it in the portfolios, because this strategy, of course, cannot make money in such conditions. Why? Because this strategy is trading to the long side, and it's trading highly volatile coins. And those coins are really underperforming these days. I will show you in a minute. But firstly, let's look at our first portfolio we started trading together. It was this V1 portfolio. This one is the high risk version. We started trading it sometimes in September. And you can see that we made pretty nice profits with this portfolio. But right now, more than 7 months, this portfolio is in a drawdown. And the drawdown is pretty deep. The drawdown is about 40-45%. Why? Well, because the tradable universe, the one we are trading, is really in a drawdown too. You can see that the tradable universe, the yellow one, was making pretty nice trends when we started trading this portfolio, but then it was really falling down heavily. But what this portfolio made is that it made slightly more profits on the upside, and it lost slightly less compared to just holding this portfolio of top 50 coins by volume. Why am I showing you this? because this portfolio, this V1 portfolio, was made of many trend strategies. Why? Because I really like trading trend strategies, because those are the most profitable over the long term, and those are also one of the most robust ones. But on the other side, I also like mean reversion strategies, and that's why we were really working hard on them, and we were adding them to the portfolio. Well, I'm really glad that we did it, because thanks to it, we didn't suffer from such a deep drawdown. Of course, the drawdown is still deep, but it's smaller compared to V1 portfolio only. But still, does it mean that this V1 portfolio is broken? Well, it's not, because this portfolio cannot make money if there is most of the time no trend. Again, there was no trend on Bitcoin, but on our tradable universe, on top 50 coins, it was much, much worse. So you really have to think about trading from bigger picture. And in this particular scenario, this portfolio just has to lose money. And with this losing, we are paying for being in the market whenever it starts moving again. So this portfolio is trying to get into some position here, into some position there, and here again, and there, sometimes even here, just to get in and out and lose a bit of money. That's part of the trading. Really, trading is about patience. But whenever a market will start trending again, this portfolio will make really nice money. We are trading much more advanced portfolio right now, much better one, much more stable, but it still delivers losses. Of course, it can deliver losses over a period of a year even, and we have to be prepared for it. I don't expect it, especially after the Trump election, but we really don't know at the end of the day. If you look at broader picture, and that's really important, you can see why we really trade the whole tradable universe of top 50 coins by volume. And this is this volatility. And also this volatility, because we don't mind if the market is falling and it is creating bear markets. We like bear markets too. Of course, we do prefer bull markets, but we also want to trade it because of this movement, which was in autumn 23 and spring 24, because the volatility of these smaller coins is really paying off. On the other side, you can see that such a universe is in a really deep, deep, deep drawdown. On the other side, if we would trade Bitcoin only right now, we would do better, of course, but we don't know if Bitcoin will be moving that much. Probably as Bitcoin is getting bigger and bigger, the opportunities will be smaller and smaller. But again, it's not about 6 months, it's not about 3 months, it's about thinking in years. It's much better, and your mind will be much calmer. What's even more interesting is if we take our tradable universe, our top 50 coins, and we rank them by rate of change, which means that we are looking at the performance of top 20 most trending coins of our tradable universe. You can see that the overperformance in these highly volatile periods compared to Bitcoin is really, really huge. Of course, on the other side, we are paying the price for getting into the market if such a universe is also falling. But that's the price we are paying for being exposed to these good times. We just need to be really patient. But it's really important to understand it. You can see it here. If we zoom in a bit, you can see that Bitcoin is on all-time high. On the other side, this tradable universe based on momentum is in a drawdown of 60-70% even, and the same with our tradable universe, big drawdown. So that's really something we have to think about, and we need to know why we are trading what we are trading. We are trading broad universe because we don't want to suffer from any bias, especially not selection bias. And that's why we are not choosing artificially a few coins that are trending right now, but we are choosing top 50 coins by volume, and this universe is changing on a daily basis. Sometimes we are paying the price for it, especially last few months. Sometimes we will get paid thanks to being exposed to these smaller projects. That's just part of the game. You can see here that our tradable universe is still in range bound market. It's really in very small chop, let's say, compared to Bitcoin. Again, Bitcoin is breaking up of this range, and it seems that we could finally get to some proper bull market again. That would be great, and for us it would be a really interesting. Just very quick overview. Let's look at V3 portfolio we are trading right now. We started trading it somewhere here, and as you can see, the portfolio is in a small drawdown since then. But why I'm having it here is just to show you the performance without the Reef trade, because I told you about the Reef trade. It was negative outlier. It was an outlier that got us to a drawdown of 10% of this V3 portfolio. And yeah, it happens. Sometimes you have to be exposed to these negative outliers to be exposed to the positive outliers. And in this movement, of the equity curve, there are many positive outliers. But positive outliers are like normal usually for us traders, and negative outliers are something we are really much more focused, especially our mind is much more focused. Over the long term, everything is only noise. Over the long term, honestly, it doesn't matter that much. Of course, for us, it does matter a lot. We spent more than a week with the scenario. We were analyzing everything, if there was something we could do better with this Reef trade. And honestly, there is not a lot what to do. Sometimes you just get these negative outliers, sometimes you get positive outliers. Everything is set that way that those positive outliers should be much more compared to the negative ones. But yeah, it just happens from time to time in trading. Also, to put things into the right perspective, there are results of V3 high risk portfolio on a logarithmic scale. You can see that 21 was huge. It's something that could happen again if we would get into very strong bull market. We don't know what Trump will do after the election, so let's see. But if proper bull market would start, we could expect really very nice performance. We don't know, but it's something that happened in the history. I wouldn't expect such a huge performance because the crypto market is already bigger compared to 21 or 2020. On the other side, if things really start moving, we could make really nice money. But it wasn't about showing you what we could make in 2021. It's more about showing you that this period on this whole chart doesn't mean almost anything. Honestly, this is the current drawdown of the V3 portfolio. And I know that with our trading, we are in a deeper drawdown because we were trading V1 and V2 portfolios. So we are in a deeper drawdown, but still it doesn't mean a lot because this is the big picture. This is the game. This is the law of large numbers. We just have to be patient. Really, I know sometimes it sucks. I don't like being a drawdown over the long term, very honestly, but it's part of the trading. So that's why I'm showing you the whole presentation here right now to understand what trading is really about. Very honestly, of course, I would much more prefer being on new all-time highs with the equity curve, and we will be there. But sometimes trading just sucks, and that's the period we are in right now. We are making a lot of research. We are trying to find if something is wrong, but there is nothing wrong with what we are trading. It's more about the tradable universe. It's about the coins that we are trading, and it's about the market. You just need to understand that we are not trading Bitcoin. We are trading top biggest coins by volume. Very important, very important. Now to our questions. So first one is, why is the max drawdown of high risk portfolio minus 20 or minus 22% right now when the expected drawdown for high risk is 40%? The main reason is that we don't have enough data in history. We tested a portfolio, we tested it from many angles on different time frames, even on different assets, but we still don't know the future. And usually the future always brings some situation which wasn't in the past. Even now, this range bound market we were in over the last 7 to 8 months, it was the longest range-bound market in crypto, which means that such a market wasn't in the data we tested and wasn't in the data we traded. That's why we even were in a deeper drawdown. The same with trend catcher. Trend catcher, for example, the strategy I showed you on the start was also in a deeper drawdown compared to the historical data. Why? Because the environment that wasn't good for such a strategy was simply longer than any time before. That's why, based on some analysis, Monte Carlo analysis, randomness of data and everything, we do expect that the max drawdown of high risk portfolio could be up to 40% more or less, medium risk 30, 35, low risk 20, 25%. So that's something you just have to expect. And you know that I'm always more conservative, especially if I'm talking about drawdowns. Another one, why is there a 16% increase in returns from low risk to high risk, but only 2x increase in max drawdown? This is pretty interesting question, and the question is about compounding effect, especially and anti-martingale money management. What it means is that, of course, high risk portfolio is trading with bigger positions, and thanks to these bigger positions, the portfolio is growing slightly quicker. But thanks to compounding effect, which means that whenever the portfolio starts growing, we are trading slightly bigger positions. And over the long term, these gains are adding up, and it's really adding up to the overall performance. That's why such a huge difference in returns. But what about drawdowns? In drawdowns, it's slightly different because we are trading anti-martingale strategy or anti-martingale money management. What it means is that whenever our portfolio gets to a drawdown, we are trading smaller and smaller positions. That's why the influence on the drawdown is much smaller compared to returns. On this chart, you can see the both portfolios without the compounding effect. You can see that the difference is not that big. Honestly, it's even pretty small, and the drawdown is close to 2% on both portfolios. But if we add compounding effect to portfolios, the difference is huge. On the other side, the influence on drawdown is not that big. So, Should you start trading high risk portfolio? No, I don't think so. Especially those that are not trading it right now shouldn't probably start trading high risk portfolio just because the drawdown is not that deep. Firstly, it can be deeper, and secondly, it's not only about drawdown, it's also about the intraday volatility. Because the intraday volatility, which means how your account is moving from day to day, is something that is influencing your trading psychology even more than the drawdown. Because if you see that your account loses 10% in a day, it's much harder than compared to losing 3 to 4% a day. So that's why I always recommend going with less volatile portfolios, low risk, medium risk, and only if you feel confident with the volatility of your account, you can go with high risk then. But even now, if you feel that the volatility of your account, the drawdown is, for example, too deep, you can still go from high risk to medium risk or from medium risk to low risk. Really, over the long term, it doesn't matter that much. You will still make nice money over the long term, but you will go through drawdowns much calmer. And that's always very important. Okay, this market update was really longer, but I wanted to talk with you about drawdowns, about trading in general, about patience, about what trading is about in terms of trading volatility, how to think about Bitcoin, how to think about our tradable universe. And that's why we spend together a little bit longer time today. If you have any questions, please feel free to ask. I'm always happy to answer anything, and we'll meet in 2 weeks again. Bye.